Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about the IWM. That is the ETF that tracks the Russell 2000 index. Today we'll discuss, did we score or did we fumble? Hello, everyone. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about the IWM, the ETF that tracks the Russell 2000 index. We discussed the trade on Tuesday as a paper trade, but one way that you could protect yourself against a downward movement in the marketplace on your small cap portfolio, or maybe you have some small caps inside your portfolio that you were a little nervous about. So what we looked at was a long put spread. Now we're taping the overtime edition on Thursday. The markets are about ready to close. But bottom line is we had a little bit of a run up in the IWM. In other words, it went the wrong direction since Tuesday, but the market has came all the way back and it's basically trading flat since Tuesday, which means our long put spread hasn't changed that much. But what we did with our long put spread is we went a little bit out of the money. And by doing that, we reduced the overall cost of the trade by going further out of the money. That gives you a small deductible, if you will, on your protection, on your hedge overall. And we went about 10 points wide. So in other words, by using a long put spread, as we're showing here in the Ally Invest Options Playbook, by doing the spread as opposed to just buying the put outright, we reduced the cost of our hedge, or i.e. an insurance policy, but we're only protected for that range, basically from where we bought the put strike down to where we sold the put strike. So let's look at how this all played out. Let's start by going to the chart. Okay, as I mentioned, today is Thursday, and we're taping this as the market is closing. We have the IWM right now at about 219.17, which is approximately 1 point higher than where the underlying was at when we talked about this potential trade or paper trade on Tuesday's Stock Play of the Day. So I've highlighted on the chart here, I've drawn a ray that goes basically from noon on Tuesday. We always tape the Stock Play of the Day live, and it's a 15-minute chart. So here's the rest of the day on Tuesday. Here is all day Wednesday. We came all the way back down on Thursday, and now this is where we're trading at. So a fairly decent move to the upside, but then again, today we have a fairly decent move to the downside. So the markets are a little bit volatile over the last couple of days. And so what happened with our trade? If I go into the Ally Invest option chains, we see that we're down about 3.3% on the IWM, $7.54. The expiration that we chose was 22 days out. So we're just basically a little bit nervous in the short term as to what's going on with the marketplace. So as I mentioned, that at the money option contract would be around $2.19. They're fairly expensive because we have volatility in the marketplace, and that's trading right around, let's call it 760 at the midpoint. So it'd be expensive to buy that at the money policy, if you will, to protect us against a downward move of the marketplace. So we ran down and said, okay, we'll take the risk from on Tuesday, the stock was at 218, from 218 down to 200. That will be basically our deductible as far as our policy is concerned, right? We're not going to get much protection by doing this trade from 218 down to 210. But at 210, we bought an option contract. Now, if we bought it outright, it would be trading for $4, let's call it $4.50 or $450, fairly expensive policy. So we said, okay, we're not nervous that it's going to go all the way down to 150 or 100. We just want to protect ourselves in the short term against maybe a 7 or 8% downward movement. So in this instance, we ended up selling the 200 strike. And part of the reason why we picked that is that we're still getting a good chunk of change for doing that. That 200 strike right now today is trading at around 245. Well, it looks like the market just moved on me. That's the thing when you're doing a live show overall. The markets are moving as we are taping. 232 right now is where it's trading at. So if I go down and I look at our trade overall, right now it's trading at 213. I'm going to put it in the right rail. There's not much that we're going to talk about. Why? Because the market's really right where it was at. And ideally, when you're doing this trade and you're trying to hedge your portfolio of small cap stocks, and that's how we're doing this with this ETF, you're really going to leave it on until the expiration date. You think of it as a cost of doing business. Very rarely do you buy car insurance and get a 6-month policy on and then decide that, oh no, after 3 months, I don't want the insurance anymore. Right. So we have at this point in time, the days remaining until that expiration is 22 days remaining. So we plan on holding this trade for the next 22 days. And ideally, the best case scenario would be that the underlying market actually went up. As I scroll back down to our workbench here. So we would like our insurance policy to actually expire worthless, and we'd like to see the Russell 2000 index go higher. Now, that was the way the market started this week overall. The market did go higher. One of the worst case scenarios that we have here is that the market just stays flat over the next 22 days and really doesn't go anywhere. So our long put spread doesn't help us out on the downside, and we don't get any benefit of our long stocks in theory, right? Our small cap stocks actually going northward, or we might be doing this on IWM by itself overall. So if I look at this trade, the initial trade was we were buying to open the March 19th, 210 expiration, and then selling to open that same expiration. Strike, the 210 strike, that same expiration though, March 19th, 200 strike put. And when we went to put on the trade, it was trading for $2.18. Now we see it trading for $2.12. So there's really not much that we would do in this case. And as I said, our goal is to use this as a protective type trade, not necessarily as a speculation, even though we did mention it on Tuesday's stock play of the day, that if you wanted to, you could use it just to speculate on the downside. Markets are a little frothy, especially in the Russell 2000 index relative to like the S&P and the NASDAQ. The Russell 2000 index has led the markets higher over the last couple of months. So maybe it's just a little bit overdone in the small caps in general. All right, that's going to be it for this edition of the Stock Play of the Day Overtime. We will be back on Tuesday's Stock Play of the Day. We tape at noon Eastern time. But if you click subscribe and ring the bell, you'll get all the reminders. Thanks for coming, everyone.